Trump collected a staggering $31.4 billion in tariffs in August 2025. But the US government is still spending into oblivion with nearly $2 trillion deficit year to date. And here's the kicker. China is allocating more and more gold than they ever have before while quietly dumping US bonds. This isn't economics anymore. This is warfare, and it has high stakes. I'm about to show you how this could trigger the largest wealth transfer in history and how you can be positioned on the winning side. Stick around to find out. Welcome back to StockScope Live. I'm your host, Ali. And if you're new here, we break down complex market dynamics into actionable insights that's useful for beginners and intermediate investors. Today's topic might sound heavy, but stick with me because understanding this could literally save your financial future. We're diving deep into what I'm calling the great financial disconnect. There's record tariff revenues paired with exploding deficits, China's gold accumulation strategy, and why Morgan Stanley is predicting another 10% dollar decline by the end of next year. More importantly, I'll give you 3 specific strategies to protect and grow your wealth during this transition. But first, smash the like button if you want more deep dive analysis like this, and make sure you're subscribed with notifications on because the pace of change is accelerating rapidly and we might have to start putting out more than one video a day just to stay ahead of the curve. Let's start with the numbers that are going to shock you. August brought in $31.4 billion, nearly triple what we collected monthly in 2024. Treasury Secretary Besant is projecting we could reach $500 billion annually. Does that sound right? Here's the problem. Despite this massive influx, the deficit for August alone was $345 billion. Let me put it in perspective. We're bringing in record tariff money, but we're still spending over 11 times more than we're collecting from those trade policies. But it actually gets worse. The fiscal year 2025 deficit is approaching $2 trillion. The only time it was higher was during the COVID bailouts in 2020, 2021. So what's actually happening here? It's simple math. The government collected $344 billion in taxes. Out of that, nearly 1/3 was paid towards their national debt interest. Didn't even touch the principal. So think about this. Americans are effectively working 4 months out of every year just to pay the minimum balance on the country's credit card. Sounds crazy, right? Well, let me tell you where it gets really concerning for your investments. The Supreme Court is hearing challenges to Trump's tariffs and his authority in November. There's multiple lower courts that have ruled against the president, basically saying that he exceeded his legal authority. If the Supreme Court upholds those rulings, the government could be forced to refund all of the billions of dollars that they collected in tariffs. And how do we know where that money goes? If I bought something from Walmart and I paid a tariff on it, does the money go back to Walmart? This is what I call the legal revenue cliff, a scenario where projected income vanishes overnight while spending obligations remain high. For investors, this means increased pressure on the Federal Reserve to keep rates low and continue money printing, which historically benefits hard assets and certain equity sectors. We'll talk about those in near future. Now let's talk about the most strategic move happening in global finance that mainstream media isn't covering properly. China has been buying gold for 10 consecutive months through August 2025, bringing their official holdings to 74 million fine troy ounces. That's about 2.3 tons worth, or $253-ish billion. And that's what they're telling us about. We know that that amount is likely 4 to 5 times larger because China doesn't report everything. And here's the key insight. This isn't just portfolio diversification. This is actually warfare, economic warfare. While China accumulates gold, they're also reducing their US Treasury holdings to $757.2 billion as of April 2025. That's the lowest level since February 2009. They've dropped from the first to third place among foreign treasury holders for the first time in over 17 years. Now, why does this matter to your portfolio? Well, China sees the writing on the wall regarding the dollar instability. They're not just preparing for de-dollarization, they're actively engineering it. Think about Trump's proposal to seize $300 billion in frozen Russian assets. If you're China holding $750 billion in US Treasuries, plus Hong Kong's additional holdings, making it closer to $1 trillion, that could theoretically be confiscated during trade war escalations. Gold in Chinese vaults in Beijing is impossible to confiscate. Here's what most analysts are missing. China is streamlining their gold import producers, increasing the number of ports that can accept gold shipments, and implementing multi-use permits for faster processing. This isn't gradual accumulations anymore. They're preparing for massive volume increases. The Chinese military, commercial banks, state-owned enterprises are all separately acquiring gold beyond what the People's Bank of China is reporting. Conservative estimates suggest true Chinese gold holdings could be 2 to 3 times their total reserves, not the official 7.6%. For investors, this creates a floor under gold prices and suggests continued upward pressure as China accelerates purchases ahead of potential dollar crisis scenarios. This brings us to the Federal Reserve impossible position and why understanding this is crucial for investment strategy. The Fed is actually trapped. They have interest payments that are nearly consuming 1/3 of their collection of the revenue. And every rate increase makes the debt service problem worse and worse. But rate cuts risk currency collapse and inflation acceleration. Now we have Stephen Miran, not to be confused with Stephen Miller, Trump's federal governor nominee, who just cleared the Senate Banking Committee. Miran is the architect of the tariff strategy and an advocate for weaker dollar. His confirmation signals a Fed increasingly influenced by political pressure rather than monetary independence. And here's the critical insight. Miran has retained his White House Council of Economics advisor's position while joining the Fed. Unprecedented political influence over monetary policy. And this is really bad. The market is already positioning for this. Morgan Stanley projects the dollar could lose another 10% by the end of next year. And we're seeing $7.2 billion in short positions against the dollar. And European investors are increasing their dollar hedging ratios from 50 to 75%. Here's what that means for different asset classes. First, real estate and commodities typically perform well during currency devaluation. Gold, silver, and commodity-producing stocks become more attractive. Second, export-heavy companies will see earning boosts from weaker dollar, but import-dependent businesses will get their margins squeezed. Third, international diversification becomes crucial. Companies with significant foreign revenue streams benefit from currency translation effects, and that's because their money is coming in from outside the country and the dollar is weaker. But where's the danger zone? The danger zone is EU investors hold $8 trillion in US stocks and bonds, with over 50% unhedged against dollar decline. When this unwinds, and it will, we could see massive capital flows out of dollar-denominated assets. For your portfolio, this suggests overweighing domestic US companies and pricing power, commodity producers, and international dividend stocks that benefit from currency translation. So, Ali, how do we position ourselves in this new crazy world? Well, I have 3 strategies that I would suggest. Number 1 is the currency hedge strategy. And this means that you're going to allocate 15 to 20% into precious metal ETFs like gold and gold miners. Then you can add commodity exposure through those things like DBA for agriculture or DJP for broader commodity exposure. These historically perform well during dollar weakness and inflation concerns. Strategy number 2 is the export winner strategy. And it's pretty straightforward. You focus on large cap US companies that generate significant international revenue, like Microsoft, Apple, those kind of companies. They benefit from weaker dollars because their stuff comes in from outside. Strategy 3 is the infrastructure play. And basically, you target domestic infrastructure utility companies that benefit from government spending. And they don't import anything from outside. Companies like Caterpillar or domestic energy producers could benefit from both infrastructure spending and reduced foreign competition from tariffs. The key is to avoid classic mistakes of going all in on a single theme. Diversification across these strategies provides protection while capturing upside potential. Remember, you're not predicting an imminent, immediate dollar collapse, but positioning for a world where dollar dominance gradually erodes while inflation pressure builds up. And that's key to understand. This is happening from 0 to 100 tomorrow. It never does. It takes time for these things to actually manifest. Look, I know this feels overwhelming, but here's the bottom line. The financial world is shifting faster than most people realize. A combination of massive deficit, geographical tensions, and strategic moves by countries like China creates both risk and opportunity. The investors who understand these trends early and position accordingly will build wealth. Those who ignore them will wonder what happened to their purchasing power in 5 years. Here's what I want to do right now. First, assess your current portfolio exposure to these themes. Are you positioned for dollar weakness? Do you have commodity exposure? Are your international positions hedged? Second, Hit the subscribe button and ring the bell so that you'll be tracking these trends with me closely, and I'll update you on the best positioning strategies as they evolve. Third, let me know in the comments what percentage of your portfolio is in gold or commodities right now. Are you prepared for dollar weakness or betting on dollar strength? I read every comment, and your insight helps shape future content. If you found this analysis valuable, share it with friends and family who need to understand these market dynamics. The more people who are financially educated, the stronger we all become. We're going to also dive into specific sectors that benefit most from reshoring trends and which companies are best positions for the infrastructure boom in coming videos. Until then, stay informed, stay diversified, stay safe, and I'll catch you in the next video.